Well, hello everyone. This is Betty Meredith, President of the Retirement Resource Center, and we are a retirement education and training company for advisors, their clients, and consumers. And I'm your session host today for this webinar with Wade Pfau on understanding how different types of annuities work. And Wade is the Program Director of the Retirement Income Certified Professional Designation and a Professor of Retirement Income at the American College of Financial Services. And I know he's truly looking forward to being here with you today and sharing his thoughts and insights. We'll go through some housekeeping items first while people are still signing in. I'd like to call your attention to the participant control panel on the right side of your screen. And if you have trouble now or during the session with the audio or visual portions of the presentation, please feel free to ask us for help by clicking on the raise hand icon or typing a message in the chat box. We'll hold questions until the end of the session so we can keep the session length to an hour. And if you have a question, please make a note of it and type it into the question box at that time. And I'd like to remind you to download or print the handout for taking notes today. You can click on the sideways triangle on the participant control panel where it says handouts, and we have them available in either 2 or 3 slides to a page, so you can choose the format you prefer. And you'll receive an email with a certificate of proof of earning 1 CE credit as long as you are on the webinar for at least 50 minutes. Partial credit cannot be awarded if you attend for less than 50 minutes. And please give the CFP board up to a week for it to be reflected in your CE records, as we'll directly report to them on your behalf. You'll have to self-report for all other certification like American College PACE, College of Financial Planning, or CLPF credits. So before I officially introduce Wade, I'd like to start with a welcome by Shelley Giordano of Enterprise Integration for Mutual of Omaha Mortgage, who is sponsoring this presentation. So Shelley, I'll now turn it over to you.
Yeah, so thank you, Betty, and the Retirement Resource Center for facilitating this series of really high quality wealth advisor seminars. We're especially proud today to be bringing such sophisticated scholarship from Dr. Wade Pfau. So when we're finished, we will all appreciate how annuities work, how they're priced, and most importantly, how they can provide secure cash flow and long retirements, also allowing your clients to possibly enjoy the equity premium. So I'd like to ask our guests to keep in mind that similarly, a reverse mortgage can be put in place to annuitize home equity for as long as the homeowner is in the home, or a reverse mortgage can be set up as a line of credit that will provide increasing borrowing power as the client ages. So actuarial principles apply to reverse mortgages in a very similar way as they apply to annuities. And the mortgage insurance that provides the non-recourse aspect of reverse mortgages is not unlike the mortality credits that we're going to learn about from Wade with annuities. So thank you very much.
Thanks, Shelley, and thank you, Mutual of Omaha, for sponsoring today's presentation. So annuities with lifetime income provisions offer risk pooling, which tends to be underappreciated as a unique source of returns that is unavailable for an investment portfolio. But there are many types of annuities in the marketplace, and understanding how they work can be complex. This presentation seeks to better provide a better understanding about different types of annuities, including income annuities such as single premium immediate annuities, deferred variable annuities, and fixed index annuities. And for these latter 2 types of annuities, Wade will focus on how they provide exposure to market upside and how optional guaranteed lifetime withdrawal benefit riders can support lifetime spending. So Dr. Wade Pfau is the Program Director of Retirement Income of the Retirement Income Certified Professional Designation and a Professor of Retirement Income at the American College for Financial Services. He is also a Principal and Director for McLean Asset Management. Wade holds a doctorate in economics from Princeton University and has published more than 60 peer-reviewed research articles in a variety of academic and practitioner journals. And he hosts the Retirement Researcher website, is a contributor to Forbes, Advisor Perspectives, the Journal of Financial Planning, and is an expert panelist for the Wall Street Journal. Wade is also the author of several books available on Amazon: Safety First Retirement Planning, an integrated approach for a worry-free retirement, How Much Can I Spend in Retirement, a guide to investment-based retirement income strategies, and reverse mortgages, how to use reverse mortgages to secure your retirement. And he also has an upcoming book, so stay tuned for that and keep an eye out on Amazon for that. So thanks, Wade, for being here with us today, and I'll now turn it over to you.
Yeah, thank you, Betty, and thanks, Shelley, and thanks everyone for joining. So this presentation will be about annuities, and there's a lot of material that I'll try to get through in about 50 minutes. I may have to go a little bit quicker through different parts of that, but just more broadly, I talk about annuities, I talk about reverse mortgages, these sorts of tools that don't always have a very good perception publicly, at least in the conventional mindset and so forth. But when you start to really look at retirement risk and how the nature of risk changes in retirement with longevity, people needing to plan for an unknown length of retirement, with the market volatility, and when you're taking distributions from assets, how that amplifies investment volatility's impact on retirement. And then with different types of spending shocks, it really opens this avenue to just look at retirement differently. And then tools like annuities, reverse mortgages, you can really see how they can have an important role in a retirement income plan and helping to manage risk and to preserve investment assets and so forth. So this presentation today is specifically on the annuity side. And like I said, I will be going quickly, but a lot of this material is available in my book, Safety First Retirement Planning, if there's an area you'd like to dive in more deeply with. Okay, so in terms of learning objectives for this, we want to distinguish between different types of annuities, including first the simple single premium immediate annuity, and then variable annuities, and then fixed index annuities, and understand the mechanics for how these different types of annuities work in terms of downside protection, upside potential, and liquidity. And then also appreciating risk pooling as a competitive source of returns for retirement income, that actually this idea that you somehow are going to underperform relative to the stock market if you use an annuity, how that's not really necessarily the case, that annuities can provide this additional source of spending that investments simply can't provide. So to get into this, we think about annuities' role in retirement income through product allocation. The idea that it's not just about the investment portfolio with systematic withdrawals, but also how different types of annuities can contribute to the retirement income plan. And a caveat about this discussion is I'm assuming quote unquote good annuities in the presentation. And what I mean by that is they're competitively priced so that the consumer is receiving the value of risk pooling. There are a lot of annuities out there, and some are heavily laden with fees above and beyond a reasonable level, so that they may not provide as much value to the consumer. But that being said, there are many good annuities that are competitively priced. Now, insurance companies do need to run a business, but net of that, the consumer can still receive value when you have a competitively priced annuity. And in terms of vocabulary, we have to start right away with terms that can get rather confusing because they may not mean what you think they mean, or they may seem to contradict themselves. But there's two main types of annuities, fixed or variable. And then annuities could either be immediate or deferred. And these terms can mean different things because a fixed annuity could have variable returns. And a variable annuity, if it's the sub-account is like a money market fund, it might have rather fixed returns. So it's not so much what specifically do the returns look like, but just how that annuity is structured in terms of, is it invested in the general account of the insurance company with a fixed annuity, or are there underlying sub-accounts that are much like managing an investment portfolio with a variable annuity? And then the immediate versus deferred can mean two different things. Technically, what it means is, when is the contract annuitized? Do you annuitize immediately and give up the liquidity of that contract? Or do you defer the annuitization? But the other way these terms can get used as well is, when does a lifetime income payment start? Does it begin immediately or within the first year? Or is that payment deferred starting at least 13 months later? And so you can have an immediate annuity with deferred income, and it can get a little bit confusing. So it is important to maintain that distinction. By immediate, I mean you're annuitizing the contract right away, and by deferred, I mean you're not annuitizing the contract right away. Even if it has a guaranteed living withdrawal benefit that lets you start lifetime income right away, the contract would not be annuitized, so it would be a deferred annuity. Okay, so to start digging into this with the income annuities, these are going to be fixed annuities, and these are also going to be immediate annuities, single premium immediate annuities, and deferred income annuities or deferred immediate annuities. They're immediate annuities because they're annuitized, but they're deferred in the sense that you're delaying the start of payments. So when we talk about these, we want to get a sense of who's covered by the annuity, who's the owner, that's the one receiving payments, who's the annuitant, that's whose life is based for determining the payments, and then if there's a beneficiary for any residual value or death benefit associated with the annuity. When do the payments start? Immediately within a year, or deferred 13 months or later? Does the annuity cover one life or two lives? What are the different flavors available? Life only would be the purest form of an annuity with the most mortality credits, the most risk pooling, because it's the idea that even if you end up only living a month after signing the contract, the payments would stop at that point. You wouldn't have any residual claim for your beneficiaries, but you get the most mortality. You give the most mortality credits to the risk pool, so you get the most back in return with the highest payout rate. Now, if you're worried about that risk that I may not live very long after the purchase of this annuity, you can add other provisions to provide something to beneficiaries. Life with period certain would be, for example, 10 years are going to be paid no matter what, and then it's life contingent beyond that. Life with a cash refund would return any of the remaining principal initial premium to the beneficiary if the owner dies before receiving that back, or I'm sorry, the annuitant dies. Life with installment refunds, same idea, but instead of receiving a lump sum refund, it's done in installments. And there are also period certain SPIAs that there's no mortality or longevity component. They pay for a fixed number of years and are not mortality based. Now, are the payments fixed or do they grow over time? There could be level payments. There could be payments with fixed cost of living adjustments, such as 2% or 3% a year. And then today, there's no commercial provider of an inflation indexed SPIA, but they have existed in the past, and that would link the growth of payments to the consumer price index. How do we price an annuity? Well, there's three main components that go into the pricing. You need to know about mortality rates, and that's why you see different annuity rates based on age and gender, because there's different mortality based on age and gender. Also, interest rates matter because the insurance company receives that premium and puts that into their general account and is able to earn interest with a rather high quality fixed income portfolio. And part of that feeds into a quoted payout rate on the annuity. And then overhead costs are just related to what the annuity provider needs to cover their business expenses and to manage the risk that they've made accurate projections about future mortality and so forth. And so this is the basic idea about pricing. And you can see right away the difference between trying to fund retirement with bonds versus trying to fund retirement with a SPIA. And we're looking at this for a 65-year-old female, and this is going to be a life-only SPIA. So there's no refund in the event of an early death. And what we're looking at here, we'll simplify the bond yield curve with a 3% interest rate, flat yield curve, and looking at receiving $10,000 a year as payments. So first of all, we look at the present discounted value of those future payments based on interest rates. And that's that discounted value of income column. If I was trying to build a bond ladder to fund $10,000 a year, through age 100 in this case, that would cost $224,872 based on the present value of those payments. Now that $10,000 payment divided by that cost of the bond ladder would be a sustainable withdrawal rate through age 100 for 35 years of 4.45%, and that's non-inflation adjusted. Now the secret sauce of the annuity is that you use that column, but you also get to discount for survival probabilities. If I'm an individual planning for my retirement, I can't pool my longevity risk on my own. I'm either alive or I'm not, so I have to set aside the full present value of my future spending. But the insurance company pools that risk across a large group of people. So they can also note that, well, when we talk about the payment at age 100, only about 10.8% of the original pool is expected to be alive at that point. And so they get to multiply that by that discounted value as well. And so from the insurance company's perspective, paying $10,000 at age 100 only requires $384 today to grow with interest and to also account for the fact that only about 11% of the people are going to be alive at that point to actually receive that life contingent payment. So when we sum those numbers and even beyond through age 104, that's $173,000. And that would be the cost of the annuity for this 65-year-old female based on this mortality data. Now, $10,000 divided by that number, that gives you the payout rate of 5.78%. And we can see the bond ladder costs 30% more than the annuity. And that's kind of the intro into the idea that we expect stocks to outperform bonds. Well, can stocks outperform bonds by enough to match what this annuity can do? It is a competitive process. I've written research articles about that it's not necessarily as easy for stocks to outperform what the annuity is able to offer above and beyond a bond yield, like a bond ladder, when you consider just the possibility of longevity in that retirement. Now, other factors that go into pricing dynamics, that was a life-only SPIA. If you want to build in a cash refund or period certain, you just have to play around with those mortality tables to account for payments that would be made, even if that individual is not alive. And then if it's for 2 lives, that's going to lower the mortality rates. There's more likelihood that somebody from that couple will be alive, and so that would lower the payout rate because it's going to raise the present value of those future payments. And also, if you have a cost of living adjustment on the payments, that's going to raise the cost of the annuity or lower its payout rate as a percentage of that cost. Now, an important thing to keep in mind is that the payout rate on the annuity is not the same as the rate of return. And sometimes people get confused about that. The payout rate includes return of principal. So it is comparable to something like the 4% rule of thumb, where you're looking at what percent of the portfolio is sustainable, which includes spending down principal as well. Now, the payout rate on the annuity will be linked to what the insurance company is able to earn on its general account that goes into the annuity quote, but it's longevity linked. It's a cash flow problem. The payout, the implied rate of return from the annuity would depend on how long I live, and then it's just, well, I paid a premium to get this monthly income for life. How many months of income did I receive, and what rate of return is implied by that? But that premium that you pay, it goes into the insurance company general account again, and the insurance company, compared to what a household can do, can generally invest for longer maturity, more diversified credit risk, less liquid assets, and also get institutional pricing, so that there may be a really nice underlying yield for the fixed income portfolio compared to what the household could earn. Now here's just a chart comparing the payout rate on this example, this 5.78% payout rate, and then what's the implied rate of return on that annuity? Well, it depends how long that individual lives, and it grows with age. If interest rates were higher, the internal rate of return would more quickly exceed the payout rate, but at the low interest rate environment, it does take longer in this example, but eventually is converging on something close to that payout rate. And then this is just the idea that if we switch from life only to some sort of refund or beneficiary provision, such as life with 10-year period certain or life with cash refund, what that does is raise the internal rate of returns on an early death, but lower the rate of return on a more prolonged lifetime. So you're giving up mortality credits in the future because you're less willing to contribute mortality credits to the risk pool if you don't live as long. And so that's kind of the trade-off in terms of that life-only SPIA. The rate of return can be very low if the person doesn't live very long. And so do you want to protect that? And if so, just the implication is you're going to have a lower implied rate of return for that longer lifetime. Now, our SPIA is expensive, and this is a general issue of our annuities expensive. And that question, it depends what type of annuity we're talking about. But fixed annuities are spread products. They don't have any quoted fees. And so you have to kind of reverse engineer to understand the pricing of the annuity and what the implied overhead costs in that annuity are. And the way you can do that is by going through this type of calculation I mentioned. You get a realistic set of assumptions about the bond yield curve, realistic assumptions for the individual about their mortality, and then you figure out what would be a fair annuity price for that person. And so if it was 5.78%, and then you look to commercial annuities, what are they paying? Well, if a commercial annuity is paying, say, 5.68%, then the difference between those would be the implied overhead charge built into the annuity. And for SPIAs, those are generally low, maybe a couple of percentage points, but generally not a high cost product in that regard. So deferred income annuities, that's where you don't start the payments right away. They can offer higher payout rates. And that's because since you're delaying the start of those payments, you're skipping all these payments where there's a very high probability the person's still alive to receive them. So you're looking at more distant payments with lower survival probabilities. And plus that premium will have more time to grow in the general account and earn interest. And so that's reflected into the calculation as well. That's why the payout rates can grow pretty quickly on a deferred income annuity relative to that SPIA or single premium immediate annuity. Then a common question asked as well is like, what age should I buy an annuity, or what age should I buy a SPIA? And Moshe Molesky created this implied longevity yield measure to discuss that. The general punchline of that is people will often say around age 75 is when mortality rates tend to pick up. And so that's when you start to getting more money's worth out of the annuity. But I think that these calculations may show that, because this is all based on a 3% yield curve, that you can actually outperform bonds even at a younger age. And so what the implied longevity yield is showing is, take a current age, so for example, 65. How much would it cost to buy $1,000 of lifetime income per year with a SPIA at that age? And in this example, it's the same assumptions from before, $17,291. And then the next column is, how much would it cost to buy a SPIA in 5 years? So when you're 70 years old, assuming interest rates don't change, and you can see the $15,197. So the implied longevity yield is, what rate of return would you need to take out $1,000 from your account for the next 5 years, and then have that $15,197 left after 5 years so that you could buy the SPIA at that point. And at age 65, it's a 3.75% implied longevity yield. That's the rate of return you would need to be on your investments to make it worthwhile to wait to buy the annuity. And because mortality rates increase with age, that implied longevity yield goes up with age. But this example is based on a 3% yield curve, so it's already at age 65 higher than bond yields. You have to take risks to get that. And you can see increasingly it's difficult to overcome that hurdle because the mortality rates are growing so quickly at advanced stages. Now, so that's the fixed annuity world as well as the immediate annuity world. Now let's talk about deferred annuities, where you're not annuitizing the contract, but you can support lifetime income through a guaranteed living withdrawal benefit. And we'll start with variable annuities. So general features of deferred variable annuities: you can have spending protection on the downside by adding these. This is something that's been developed since the 1990s, these guaranteed lifetime withdrawal benefits, or GLWBs. They support a lifetime income without annuitizing the contract, at least not right away. It's a deferred annuitization. If the account value ever depletes, that will trigger the annuitization to support the lifetime income at the level promised through that guaranteed living withdrawal benefit. Meanwhile, you still have control of the assets, so you can invest those in sub-accounts and have upside potential, as well as, depending on how the contract works, there could be step-up opportunities to increase the amount of guaranteed income. These contracts are liquid when they're deferred because you haven't annuitized the contract, and then you always have the tax deferral with annuities. Now, behaviorally, an individual can obtain risk pooling without having to quote unquote sacrifice the annuity. And just behaviorally, that's a concern people have with SPIAs, that they give up the asset. It's not on their balance sheet, or it's not on their portfolio statement. They still own this present value, but it's just not as tangible when they can't see it on a portfolio statement. Well, with the variable annuity, they can continue to see that. It's still on their balance sheet. It may also make them feel more comfortable investing more aggressively because they have that income protection in place. And also because they know that they have this lifetime protection, providing this downside risk protection, that they can stay the course in the face of market volatility. There's a lot of vocabulary with both variable and fixed index annuities. And when they have these living benefits, much of it relates to the living benefits. So you have a guaranteed lifetime withdrawal benefit. It's going to be based on a benefit base, and that benefit base may grow in a deferral period before lifetime income begins with a set roll-up rate. There is an underlying contract value that's different from that phantom benefit base that's just used to calculate lifetime income. There could be step-up opportunities if the contract value achieves new high watermarks above and beyond what the roll-up rate would provide. And then also there's a usually age-based guaranteed withdrawal rate that you apply to the benefit base to determine the lifetime income. Now, different contracts may use slightly different terminology for these terms, but this is what I'll use with our explanations today. Some key issues we want to look at is, with a living benefit, how do those guarantees grow during the deferral period? How are guaranteed withdrawals determined? what is the death benefit on the contract, and then how does the insurance company manage its risks. So we'll talk about a VA that you put $100,000 in as a premium and with a 10-year deferral period here. And here's 5 types of roll-ups on the benefit base: 5% simple, 5% compounded, 6% simple, 6% compounded. And you can see, what is the benefit base going to be 10 years later? Well, with simple, you're just getting that 5% or 6% of the premium added each year. So you're growing to be, with the 5% simple, $150,000. With 5% compounded, you're getting that interest on interest, or the benefit base, you're getting a 5% growth on the previous benefit base, not just the initial premium. And so that's almost $163,000 after 10 years. And you can see after 10 years, 5% compounded is getting you more benefit base than 6% simple. And 6% compounded would be getting you close to an 8% simple roll-up rate. Here's what that roll-up rate would look like. This is for 5% annually compounded roll-up rates. So you can see how the benefit base that would be used to calculate income grows over time. And it is that step function, because usually you have to wait to the anniversary date for that roll-up to be vested and to get that increase in the benefit base. That's why you see the steps every year at the end, at the calendar anniversary date of the contract, you get that 5% compounded roll-up applied to the benefit base. Now, the roll-up rate is not a guaranteed rate of return, and that's a common source of confusion with consumers, where if they say have a 6% roll-up rate, they think their annuity is earning a 6% guaranteed rate of return. But that's not what it means. It's about determining that benefit base that will be used to calculate lifetime income. There could be other compounding frequencies. It doesn't have to be annual. I'm just using that as a simple example. And also, like I was saying with the roll-ups, they're usually, even if the compounding frequency was daily or monthly, usually those roll-ups would still not be vested to actually make that benefit base longer until the contract anniversary date. And then you have step-up opportunities. That's when the contract value grows to achieve new high levels on any particular anniversary date of the contract. So if it's annual, you'd only look at on each year anniversary. What's the value of the contract? And is it a new high watermark? Is it higher than it ever was in the past? If so, that would step up the benefit base to that level. Now, you could also do that more frequently, daily, monthly, quarterly. If so, that gives you more opportunities to achieve new high watermarks. So there is value in more frequent step-up opportunities. And again, still though, they usually wouldn't vest until the anniversary. And then another important question is, do the roll-ups stack on the step-ups? And to understand the meaning there, it's best to just look at a simple example. So the yellow dashed line is the contract value of a variable annuity purchased at age 55 for $100,000. You see it kind of, the market's down for a while, but at age 59, going into age 59, there's a big boost in the market. It's getting to a new high level, and then it kind of stagnates again after that. So what's happening with this contract is you're getting the roll-ups. This was the 5-year compounded roll-up rate every year. And so the roll-ups are higher than the contract value until age 59. At age 59, we're going to get a step up. The contract value exceeds the benefit base at that point and steps up the benefit base to that new high level. Now, if the contract does not stack, the roll-ups still continue to apply the original premium, and that's going to be that dashed purple line, where then with that gray line, your benefit base is flat until about age 63, and then continues on its original path. Whereas if there is stacking, if the step-ups stack on the roll, or the roll-ups stack on the step-ups, I should say, then you get that 5% compounded growth based on the benefit base value at age 59. And so by the time you get to age 65, if this contract has stacking, it would provide a 19% higher benefit base. Then what is going to be the guaranteed spending amount from that contract? Well, that's that guaranteed withdrawal amount based on the guaranteed lifetime withdrawal benefit, which is going to be an age-based withdrawal rate. And that table of age-based withdrawal rates would be part of the initial contract, times the benefit base when you tell the insurance company you're ready to start taking the lifetime distributions. That's not annuitizing the contract, but it's turning on the lifetime income through the guaranteed living withdrawal benefit. Once you switch from the deferral period with roll-ups into the distribution phase where you're taking your lifetime income distributions, roll-ups would end. There's no more roll-ups during the distribution phase, but step-ups are usually still available. And that's if net, now this has to be net of the distributions, if the contract value can now achieve a new high watermark on an anniversary, then you can have that additional step up to the benefit base and then apply that age-based withdrawal rate to this newly increased benefit base to get a higher lifetime income amount. There are different types of living benefits, but the only one that supports lifetime income without an annuitization of the contract, and what's most popular today is the guaranteed living withdrawal benefit. Now, when we think about a SPIA versus a variable annuity, usually a SPIA will have a higher payout rate. Especially we should think about a SPIA with a cash refund to be as close as possible to what a variable annuity can offer. And so this is hypothetical, but we see the purple curve would be SPIA rates, and then the yellow curve would be these age-based factors for the downside worst case scenario on the variable annuity. And the difference between them, this is the worst case scenarios, if there's no step-ups beyond the roll-up on that VA, you'd be getting a lower payout rate or less income out of that contract. And that's the cost of the liquidity provided to the VA as well as the upside potential. And so someone then has to assess, is it worth it? Would they rather get a SPIA that may offer higher downside guaranteed protections, or do they want to use the variable annuity, which may have a lower downside guarantee, but has liquidity and more upside potential? Then, kind of back to this issue about roll-up rates are not guaranteed rates of return. This can lead to confusion because what matters is the roll-up rate and the withdrawal rate and how they interact based on the deferral period. So we're back to this example with a 10-year deferral period, and we're looking at different combinations of roll-up rates and withdrawal rates. And so there are contracts that have 10% simple roll-up rates. It's very easy for someone to think, I'm getting a 10% guaranteed rate of return. But to just pull out two numbers from this chart, if we look at a contract where someone's focused on that 10% simple roll-up, and that contract has a 4.5% withdrawal rate at age 65, then in the worst case scenario where I'm just getting roll-ups without step-ups, I'm gonna get $9,000 of income out of that contract. And if we compare that to another contract that has a 6.5% compounded roll-up and a 5% withdrawal rate, you're actually getting more guaranteed downside protection from the contract with $93.86 as the amount coming out of that contract for a $100,000 premium. So if someone gets too focused on saying, well, I've got a 10% roll-up, I'm getting a 10% guaranteed rate of return, that's not telling the whole story. It's the interaction of the roll-up and the withdrawal rate. And if the arms race between companies is everyone's only focused on roll-up rates, it's easy to insert that with a lower withdrawal rate and to not really be providing a better outcome to that individual. It's very important, based on the planned deferral period, to look at that interaction of roll-ups with withdrawal rates. Then a variable annuity contract can be in the money, and that's if the contract value is less than the benefit base. That makes the guaranteed living withdrawal benefit more valuable because it's more likely that the contract could deplete and provide better support through the guaranteed income. So you might look at a legacy contract that a client brings in, and it could be an awful variable annuity. I mean, who knows? But if that contract value is very low relative to the benefit base, the best thing for that contract might be to keep it at that point, because you have to compare, well, what if I take the contract value out and do something else with it, versus if it's a low contract value relative to the benefit base and the contract is in the money, then based on what you have left, it could be a very good deal to keep that contract and to not exchange it into something else. With death benefits, the basic death benefit of the VA will generally be you get your full initial premium out of the contract or something along those lines. And there can be optional death benefit riders as well, but they may be incompatible with living benefit riders, because with a living benefit, you really want to deplete that contract to get the most out of it, because that puts the insurance company on the hook to make those payments. And with the death benefit, often to get that death benefit, it could be you'll get your full premium back as long as there's at least $1 left in the contract. That's not compatible with trying to get the most out of a living benefit, because you're forced to preserve $1 to get the death benefit. So you often wouldn't want to have both on the same contract. But there could be a role for death benefits for people who don't need the living benefit. They may be using that contract either to cover their RMDs and still support the initial premium or something along those lines. So this idea of deferred annuitization, the owner of the contract spending their own money until the contract value depletes, and the insurance companies only actually on the hook to support the guarantee after the account depletes. So that's risk from the insurance company's perspective, that they have to support this guarantee even if there's no money left in the account. So how do they manage that risk? Well, some options include just having a strong company culture in terms of financial performance and risk management. Playing around with those parameters, like I was saying, you could have a very high roll-up rate, but if that's attached to a low withdrawal rate, then the consumer may not realize they're not getting as great a deal from that contract. Choosing high quality managers for the investment sub-accounts, and you'll see that quite frequently. The insurance companies put a lot of effort into, not anyone can be in their sub-account manager. They only want high quality managers because they want people to preserve assets so that if the account performs very poorly, that creates more trouble for the insurance company. They may also limit the volatility allowed in those sub-accounts, either by capping the risky asset allocation, or by requiring the use of volatility controlled funds, or by requiring some holding of a cash position. And they can also adjust the fees associated with that contract. Now, variable annuity fees are important because when we hear about the idea that annuities are expensive, what's usually meant is a variable annuity. The fees include underlying fund expenses, a mortality and expense charge, surrender charges, which only apply if you're taking excess distributions in the early years of the contract. But if you're treating it as a long-term retirement income tool, you don't have to worry about the surrender charges. And then charges for any optional, any living benefits or death benefits that you want to add to the contract. Now, more and more today, we see fee-only annuities available that don't pay commissions. And by not paying commissions, they can work with like an asset under management based financial advisory fee-only firm, and they can have reduced M&E charges as well as reduced surrender charges because they don't have to bake that commission into the contract. In terms of fees, though, the idea of the higher fee drag on a VA, that's not really the whole story, because with risk pooling, for somebody who's worried about outliving their money and is trying to self-manage their longevity and market risk, they might have to assume a low withdrawal rate. I mean, that's the whole logic of the 4% rule of thumb. It's what if I end up living a long time and get bad market returns? How much assets do I need to feel comfortable with retirement? Well, by not having to self-manage that and by pulling that risk through the insurance company, I may find that I can retire with less assets. And then it's not really the fee drag that matters, it's how much will my retirement cost in terms of assets I need before I can comfortably retire. And an annuity offering risk pooling can allow for less assets to support a retirement goal. And that's really how I think one should be thinking about fees. And also there's the asset allocation side of that. If I have protected income, I have more risk capacity. My lifestyle's less vulnerable to market downturns. I can invest more aggressively. Then if I do that and I have that upside exposure, then net of fees, I may have a better outcome so that I can better support spending and preserve a larger net legacy through the idea of investing more aggressively because I have the annuity in place. And that can overcome the fee drag so that it's not necessarily going to be the case that you hurt legacy by using a variable annuity as part of the retirement income plan. Then fixed index annuities. So these are back to fixed annuities, although they can offer a variable rate of return, but they're fixed annuities because they're going to have principal protection. There can't be a loss on the contract value, at least not, I mean, if you have an optional living benefit with a fee, that can eat into the contract value. But otherwise, the contract value is protected from investment loss. The lifetime spending protection can be available with these as well through a GLWB. You have some degree of upside potential, and we can think about a spectrum with SPIAs on one side, no upside potential, but highest downside guarantees. Fixed index annuities would usually be somewhere in the middle, relatively high downside guaranteed income, but less upside potential, some upside potential. And then the variable annuity would be at the other extreme with usually lowest downside guarantee, but the most upside potential. And these contracts are also liquid because they're deferred, and you also get that tax deferral. then the same idea here, you get that risk pooling without having to quote unquote sacrifice the asset. It's not like a SPIA. You can still see the assets on the balance sheet. And also these are unique because of the principal protection, that you can't have a loss. Even if you're linked to a stock market index that's down 40%, you're not going to have a loss in the contract. And so you can have more comfort investing more aggressively elsewhere with these as well. So we've got vocabulary for fixed index annuities, and we talk about the interest crediting method, the guaranteed lifetime withdrawal benefit, the benefit base, and the roll-up rate. Could be one way they're structured, just like the VA, but more commonly, we're probably going to see what's known as a deferral credit, and that will be the approach I take to explaining them. And with a deferral credit, you don't need a benefit base, so we'll get into that. The contract value, the step-up opportunities, and the guaranteed withdrawal rate. And the step-up opportunities would only apply if there's a benefit base as well. So some key issues here. How is the interest credited to the contract? With a living benefit, how is the guaranteed withdrawal determined? What's the death benefit? And how does the insurance company manage its risks? So the crediting method is about the return, quote unquote, return on the FIA. It's how is interest credited to the contract? It could be a fixed interest rate, and usually you have the flexibility to choose what you want and can change over time. Do you want their fixed rate, or do you want to link to the performance of an external index? The most common of these would be the S&P 500, but there's also a number of other indices that you might link these the contracts to. With that linked index, the fixed index annuity does not invest in the index, which is going to be an important point. They're going to base the performance through financial derivatives. So because there's not actually ownership in that index, market index, you're not going to be looking at total returns. You're only going to be looking at price returns without dividends, because that's how financial derivatives such as call options work. They're based on the price returns. There's principal protection again, because these are fixed annuities. The contract value will not decrease when the index experiences a loss. And now we're increasingly seeing things that have a number of names, but I guess we're kind of converging on a RILA is the name, a registered index linked annuity. That looks a lot like a fixed index annuity, but it can allow for losses. It doesn't have principal protection. So there could be a floor on the loss, or it could be like a buffer where a certain portion of the loss is eaten by the contract and then you're exposed to anything beyond that. But those are, even though they look a lot like a VA, they're a lot like an FIA, they're technically a variable annuity because they are exposed to loss. To be a fixed index annuity, you have to have principal protection. And in terms of the fees on a fixed index annuity, so often you might say that these quote unquote don't have fees. And that's because these are spread products like SPIAs or like checking accounts and so forth. So it is the case that there are no fund expenses because it doesn't invest, there's no sub-accounts, and there's no mortality and expense charges. Now there could be surrender charges, and there will be charges for any optional lifetime income benefits or death benefits. But otherwise, we're talking about that unobserved internal spread, just like a single premium annuity. And you can calculate the money's worth, but that requires reverse engineering. What would be the fair price of an FIA versus what's the actual quoted price on the market? And then again, just like the variable annuity, there are now fee-only versions of these that don't pay commissions, and so they can reduce or eliminate surrender charges, as well as offer the lower unobserved internal spreads. Now, the interest crediting method can be designed in 100 different ways, and so you could spend hours just talking about how different crediting methods work. But I think by far the most common method is going to be, it may not be 1 year, it could be a multiple year, but I'll explain this in terms of 1 year, but the rest is the most common. So I'll say 1 year term, a point-to-point crediting method with an annual reset. Because these are the most common, they should be more competitive in terms of their pricing. Again, it could be a different length, but I'll just talk about one year to simplify that. Point-to-point means you look at the value of the market index at the start of and end of that term and look at the price return during that period. You credit interest for the year based on that index price return. So again, excluding dividends, and you get the annual reset. You get to start fresh each year. There's no need for cumulative gains to make up for previous losses. So if we're linked to an index that went down 40% this year, our credited interest for the year would be 0%. And then next year we get to start the process over. We don't have to make up any sort of loss from this year. And so the basic idea of how these work, you're going to buy enough bonds to protect the principal after that interest is received. And because bonds hopefully earn positive interest, though we know now the interest rates are very low, so there's not going to be a much excess beyond this. But for anything beyond that, then that's going to be divided in two ways. Part will go to the insurance company to cover its expenses and risk management and so forth. And so that would be that internal spread. And then the rest of it will be used to, it's the options budget. It's going to be used to purchase the upside exposure to the link indexed. And that's basically, we can think they'll buy call options on the index. And so if the index is down, those call options expire worthless, but the principal is protected through the bonds that are owned. And if that contract gains value, if the index gains value, then the call option is going to give you that portion of the upside based on how much call options you can purchase, how much you have in that options budget. So beyond that, we've got a number of different parameters that you can play around with between floors and participation rates and caps and spreads, and those buffers again get into the idea of allowing for potential losses. But the floor for a fixed index annuity, the floor will be 0%. It could be negative for a variable version of these, but 0% floor. And then basically, would you want a cap rate, which would give you 100% participation up to a cap and then nothing beyond that? Or do you just want a participation rate, which gives you some participation of the upside? And I'll show an example of that shortly, but in terms of what those parameters are going to be, the important factors are the level of interest rates, which is feeding into, most importantly, how much do you need for principal protection? What's the options budget going to be to purchase upside exposure? And then the cost of the financial derivatives to actually purchase that upside exposure. Now, those financial derivatives depend on a number of factors, and you can think about the Black-Scholes options pricing formula, which is where all these are coming from. To get to this part more quickly, because a lot of this isn't as important, but implied volatility is by far the most important factor for determining the call option price. When the underlying index is more volatile, the option becomes more expensive, and so the insurance company can't buy as much upside exposure. That's why you may see low volatility indices used in fixed index annuities, because with a lower volatility and a lower implied volatility, more of that upside exposure can be purchased. And then each term, this process would be repeated. So each term, the insurance company needs to preserve the right to change the parameters because they have to go into the open market at that point, and they have to buy enough bonds to protect the principal, and then they have to buy the financial derivatives to give the upside exposure. So again, that degree of upside exposure depends on where are the interest rates and what are those other factors that go into the options price. And like I said, insurance companies have to maintain the right to change those parameters, but good companies will not take advantage of this. So it's important to look at the renewal history of past contracts with that insurance company to get a sense of how they're treating their existing policyholders. And not that that's any sort of guarantee they'll do the same in the future, but a company that has a good history with not changing parameters in a dramatically negative way on existing clients may be a good sign, especially during any surrender charge period. Okay, so what's the best crediting method? Well, the answer is we only would know in hindsight which is going to work best. So if you can guess what the market's going to do in the future, that can guide you towards a better crediting method. But beyond that, for competitively priced FIAs, it shouldn't really matter which crediting method you choose. It's just one will work better based on what happened in hindsight, but before the fact, you don't really know what's going to happen. And that's where, to see an example, like let's suppose we're looking at two options with a contract. Do we want to have a participation rate of 56% or a cap rate of 6%? Well, if the index has a negative return, it didn't matter because you're getting a 0% credited interest with the floor. But what we can see is the cap rate will work better if the index price returns between 0 and 10.7%. The participation rate would work better if the price return is greater than 10.7%. So again, the idea is if I believe the market's going to do really well, I'd probably want to pick the participation rate. If I think market returns will be more muted, I'd probably want to pick the cap rate. But to the extent I don't really know what's going to happen in the future, it's hard to say that one of these would be better than the other. It's really, at that point, just what is the individual most comfortable using. Now, if the term length is longer than a year, advantages of that is you're locking in the current parameters for longer, and because the price of a call option does not grow in a linear rate with the length of maturity, you'll get more upside from the financial derivatives. But a big downside of a longer term is usually no interest gets credited until the end of the term. So if you have like a 6-year term, 5 years into that, there's no increase in the contract value. No interest is credited until the end of the term. Usually, there's no standardization about any of this, so you might find exceptions out there, but in the usual case, that's how it would work. Now with step-up opportunities, in new high watermarks, but this whole issue may be less common with fixed index annuities. And especially if the cap rate is less than any sort of roll-up rate or distribution rate, then you don't really have an opportunity for a step up because the contract value will never be able to grow more than that. So really, you should be much more focused with the guaranteed income and not with the upside potential when we talk about a fixed index annuity. And like I said, these could work in the same way as a variable annuity, but I'll just explain the other way that sometimes variable annuities actually do what you see on this slide, but this would be more common with a fixed index annuity, where it's a withdrawal rate times a benefit base, but that benefit base may just simply be the contract value. There may not really be a separate benefit base. And so that withdrawal rate will be based on the age the contract is issued, and then there may be some sort of age-based deferral credit and length of deferral to see what the withdrawal rate is. So for example, if I purchase this contract and at that point, like say I'm 55 and at that age, the payout rate is 4.5%, I then defer for 10 years and the contract offers a 30 basis point deferral credit for each year, I'd have a 7.5% payout rate at age 65. And I would apply that to, you could call it the benefit base, but it may just really be the contract value. What is the 7.5% of the contract value at age 65? And that's going to give you that guaranteed lifetime income amount. So now, like in theory, an FIA should have a lower payout rate than a SPIA, but in practice, that's not always the case. And that may just be because people can make behavioral mistakes with FIAs where they don't take full advantage of the contract. And so then those who understand the contract better and can take full advantage of it through competitive pricing may be getting a better deal. And so you can occasionally see an FIA, despite having the liquidity and some of the upside, could offer a higher payout rate than a SPIA. And so it's worth looking into that. And then in terms of managing risk with these, well, there is no market risk because we know the worst case scenario already. We know exactly when the money would run out if there's never any market gain because it's all just going into bonds and expired call options. So longevity risk is the only thing that needs to be managed, not market risk from the insurance company's perspective. But then they can adjust the guaranteed payout rates. They can adjust the parameters, like what is that participation rate or what is the cap rate, to give less upside exposure so that they can put less into the options budget and keep more in that other internal budget. They can adjust the parameters to reflect new market conditions in an honest way, and that's again important for them to be able to do that. And they can also adjust the living benefit rider fees. Usually there's some limit on how high those can go, but the contract will say right now maybe the living benefit is 1% of the contract value, but the insurance company may preserve the right, for example, to increase that up to 1.5%. And that's another way to manage this risk. So FIAs as an asset class, you could think of using these without the living benefits because you have the principal protection. Their yields can be competitive with bonds, especially net of taxes. But don't, even if it's linked to a stock index, don't usually think of it as a stock replacement. Then fitting annuities into a financial plan. Again, with a bond, you get principal and interest. And with an investment portfolio more broadly, you're adding capital gains or the risk premium. Well, with an annuity, you're getting principal interest and then risk pooling or mortality credits to get that sort of competition. And then when we think about the retirement income plan, I talk about the 4 L's as the goals on the left, and they map into liabilities or expenses associated with those goals. and then positioning assets between reliable income, diversified portfolio, and reserves to fund those liabilities. And the role of the annuity then is as an income gap, filling an income gap. If you'd like to have additional reliable income beyond Social Security and pensions, and maybe that reverse mortgage 10-year payment, you could also look to an annuity to fill that gap. So some key takeaways, we want to make sure we understand how different types of annuities work and how they can add value to the retirement income plan. Noting that annuitized contracts lose liquidity and upside, but generally offer the highest guaranteed income. That deferred annuities with living benefits continue to provide liquidity and upside. And that variable annuities generally offer more upside potential, but less downside income guarantees than fixed index annuities. So thank you, and let me hand the floor over to Shelley. I think, Shelley, you've got a couple things to tell everyone. I've got the order right.
Thank you, Wade. Thank you. Betty, did you want to take questions first, or are we going to move through? Just quickly go through some slides. Thank you all, and thank you, Dr. Pfau. It's so interesting. I do want to just call your attention, our guests, to the Academy for Home Equity and Financial Planning at the University of Illinois. You can see this picture here where Wade is standing next to me, along with Jamie Hopkins and Rita and Betty Sachs and Tom Davison and Sandra Timmerman, Rita Chang, at a meeting where we attended at the Investment News Retirement Summit. But the point of it is to let you know that Dr. Pfau is a member of the Academy, and we so appreciate, as I said earlier, his scholarship, particularly sort of his groundbreaking look at how home equity can contribute to a safer retirement. Next slide. And we mentioned at the beginning that the reverse mortgage is secured by FHA mortgage insurance, and this makes the reverse mortgage a non-recourse loan. So Dr. Pfau has written a couple of books on reverse mortgages, but again, I want to just call your attention to what he calls the four nevers. And this basically is at the heart of the non-recourse aspect of the reverse mortgage, which makes it so secure. So the clients never give up title to the house. The bank does not get the house. That's the #1 myth with a reverse mortgage. The client can never owe more than the home's value. So even if the client lives way beyond life expectancy or home values drop, he or his estate will never be required to pay more than what the house provides at sale. A lot of people think that if you take out a reverse mortgage and you are run out of money, that you're going to be kicked to the curb, to put it bluntly. That cannot happen. The reverse mortgage is always in place. Even if the available credit has been exhausted, the homeowner has the right to remain in the house. And the client never has to make a payment on the principal or the interest until the last one of them leaves the house permanently. So just a few things that we'd like to be able to provide for you. Next slide. We have a little film, which video here that references Dr. Pfau's work, demonstrating that a reverse mortgage can be a buffer asset and protect against that early sequence of returns risk. And the final slide here. And also would like to offer you this booklet on all of the strategies that have been identified for using a reverse mortgage to provide a more secure retirement. So just send me a note, sg.mutualmortgage.com. I'll be happy to send you the video and or the booklet here to help you understand all of the research that has been done around using home equity to improve retirement outcomes. All right, that's all for us, Mutual Omaha.
All right. So Wade, I do have a couple of questions. So we do have a minute left here, so maybe we can at least get to one of them here. Is there such a thing as an annuity that allows you to tap the principal after it's been annuitized? And I'm probably thinking they're thinking of, annuities from a while ago in prior years.
Yeah, that can exist. Like sometimes SPIAs or DIAs do have a way, even though you've annuitized the contract, to have some liquidity. And so that's not that normally when we think of a SPIA or DIA that's been annuitized, you don't have access to the funds anymore. But no, that can exist. It's possible.
Okay. And then this is one that's just using that annuitization principle under the logic that you retire with less assets if you have removed longevity risk by having an annuity with the GLWB. How do you feel? Do you feel the same about having a pension? So some people get lump sums offered to them. Do you recommend pension payments or lump sum payments?
Yeah, I mean, those two factors interrelate with each other. You're thinking about first, like how much reliable income do I want? And then like when you're looking at that pension decision, look at, well, what is the lump sum amount and what is the monthly income amount? And then look at, well, if I take that lump sum amount and I put part of it into an annuity, can I get a better deal through the commercial annuity or can I get a better deal through the company pension? And if the company pension looks to be a better deal, you might want to, if you have the option to split it, you might at least want to get part of that as the pension instead of using the commercial annuity. But if the commercial annuity looks to have a better deal, just go with take the lump sum and put part of that into the commercial annuity. And that can also give you more control over when you start the income payments and so forth. So then if you already, like how the question was also asked, if you already have the annuity and then you're thinking about the pension decision, that could relate more towards, well, you can always, since it's a deferred annuity, you can always surrender the contract if the pension has a much better deal in terms of its lifetime payout rate. But otherwise, you can just think about, do I want more reliable income or not? If I've already got enough covered with my Social Security and that variable annuity and so forth, you might take the lump sum in that case. If you want more reliable income, you could still take the pension lifetime payments in that particular case.
Right. Yep. All right. People are asking, can they see this again? Yes, it'll be available for 30 days. So you will receive an email that gives you a link to that as well. So, and also we'll wrap up now. So proof of CE will be emailed to you to confirm your attendance. And again, for those of you who opted in, we'll report it directly to the CFP board on your behalf. And you will need to self-report for all other professional certification CE. And we also thank you in advance for filling the out the evaluation at the end once you leave the presentation. So that's it, everyone, for today for this webinar sponsored by Mutual of Omaha Mortgage. Wade, Shelley, myself, and the rest of our team, thank you for participating today. Have a wonderful rest of the day. We look forward to being with you again in the near future. Take care.
Thank you.
Thank you, Dr. Pfau. Thank you, Betty.
Thanks, Shelley. Thanks, Betty.